Let me ask you something. If someone from Wall Street called you and said, hey, this is a limited opportunity, big money is already in, you just need to act fast, would you at least listen? In the early 1990s, thousands of people did exactly that. And most of them didn't lose money because they were careless. They lost money because the deal was already decided before they ever picked up the phone. That story later became famous as the Wolf of Wall Street. But the real story isn't about partying or luxury. It's about how a financial system failed ordinary investors. To really understand this story, we need to understand Wall Street at that time. This was a period when sales culture dominated finance. Commissions mattered more than advice, and enforcement moved slower than innovation. If you could sell confidently, you didn't need to be right. You just needed people to believe you. That environment created the perfect conditions for abuse. Jordan Belfort wasn't a finance genius. He wasn't known for market analysis or valuation models. What he was exceptional at was persuasion. He understood how people think when money is involved. He knew how to create urgency. He knew how to sound like an insider. And in finance, confidence often sounds like competence, even when it isn't. Belfort entered Wall Street during a time of high risk and high reward. He saw quickly that traditional investing was slow and limited, but selling low-quality stocks offered something different: massive commissions. That realization changed everything. He wasn't interested in building value. He was interested in building volume. Eventually, Belfort co-founded a brokerage firm called Stratton Oakmont. On the surface, it looked legitimate. Phones, suits, licenses, everything checked out. But internally, it operated like a pressure cooker. Brokers weren't trained to evaluate companies. They were trained to close deals fast. If a stock paid high commissions, that's what they sold, no matter how risky it was. Here's the most important part of the story. Stratton Oakmont focused on penny stocks, low-priced, thinly traded shares. First, the firm quietly bought large amounts of these stocks at very low prices. Then, brokers aggressively pitched them to everyday investors. They used big promises, limited time pressure, and confident language. As demand increased, prices went up. And right when investors felt confident, the insiders sold their shares. Once that selling started, prices collapsed. The firm kept the profits, investors kept the losses. This process is called pump and dump, and it was repeated over and over again. Here's what's important to understand. Most victims weren't greedy or careless. They trusted their brokers. They believed they were getting professional advice. Many didn't have access to real-time market data. And when someone speaks confidently and sounds experienced, it's easy to assume they know what they're doing. Finance becomes dangerous when trust replaces verification. Inside Stratton Oakmont, success was rewarded aggressively. Top performers were celebrated. Money flowed freely. Ethics weren't part of the conversation. When behavior is rewarded, it spreads. Over time, the line between aggressive sales and fraud disappeared completely. Thousands of investors were affected. Losses reached hundreds of millions of dollars. For many people, this wasn't extra money. It was retirement savings, college funds, life savings. Meanwhile, the firm generated enormous internal profits. That imbalance continued until regulators could no longer ignore it. Federal investigators began connecting the dots. They analyzed phone recordings, trading patterns, internal compensation structures. The pattern was clear. Jordan Belfort was charged with securities fraud and money laundering. He eventually cooperated with the authorities, which reduced his prison sentence. But by that point, the damage was already done. This story isn't just about one man. It's about incentives. When brokers are paid to sell instead of advise, when speed matters more than accuracy, and when oversight lags behind behavior, fraud becomes predictable. The names change, the tactics evolve, but the structure stays the same. The Wolf of Wall Street wasn't a success story. It was a warning, a reminder that real investing is usually boring, and that's a good thing. If someone promises easy money, urgency, and insider access, that's the moment to slow down, not speed up. If you understand stories like this, you're already a step ahead. This is Capital M Files, where financial stories are explained clearly, honestly, and without hype.